Alright, hey guys, Scott here again with a brand new video, and for this one, I'll be showing you all when you should be much more aggressive as an option seller and when you should be much more cautious and scale back your risk. And right now, for example, would be a situation where, in my opinion, you should definitely be cautious and have a lot of spare capital or spare gunpowder, so to speak, just waiting and sitting on the sidelines for a much better opportunity to come around. And so basically the deciding factor in how much you should scale up or scale down your risk is going to be the VIX index. So we'll take a look at that in detail for this video. And specifically the value of that index is again going to be that deciding factor in your overall risk exposure as an option seller. Now briefly though, before we get started here, make sure you guys watch until the end of the video because at that point, I've got a very cool opportunity for you all where you can receive up to 10 free stocks. And also here, for anybody who would like to join a very exclusive online community where you can learn how to successfully trade options and learn my custom approach to the markets, then you can now join my options trading Discord. So definitely check out the description of the video below to learn a lot more about that. And then finally here, for anybody who is brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join Skillshare using those links, you'll get a full 1 month free trial. Alright guys, so now we'll dive in here, and like I said, the major thing we'll look at in this video is going to be the VIX index. So there's a few ways you can analyze the VIX. So for example here, you can go right to VIX, which is the actual VIX index here. But I do personally prefer to look at /VX, which is the VIX index futures contracts. The reason being is that the VIX futures market tends to give you a more accurate measurement of where implied volatility actually is right now. But regardless here, what the VIX shows you is the implied volatility for specifically the S&P 500. And in case you're not aware, implied volatility is basically a measurement of uncertainty about the future. And also, most importantly, implied volatility is used to price option contracts, right? So specifically, as implied volatility goes higher or as uncertainty about the future goes higher, so do option prices. They go up as well. And then conversely, as implied volatility contracts and goes back down, so do option prices. So therefore, as an option seller, you always want implied volatility to contract, right? Because whenever you sell an option, the only way to make money on that contract is for the price of that contract to come down. And that's exactly what implied volatility contraction will do for you. Now, the good news is that historically speaking, most of the time implied volatility does contract. So that's one of the major benefits of being an option seller. But as you can see here in this chart, especially in this current bear market of 2022, there are lots of occasions where implied volatility has spiked quite significantly. And so as a result of that, if you sold options before one of these large spikes here, then once that spike in implied volatility occurred, you are going to lose a lot of money, right? Because again, when that happens, the prices of your contracts are going to skyrocket, and that's going to cause you to lose money. Now, one very important thing to understand about implied volatility and its relationship with the broader market is that these large spikes pretty much always occur during very large sell-offs in the market. So for example, if we come to SPX real quick, which is the S&P 500 index, and then if we come down below and take a look at this chart, this is showing you the implied volatility for the S&P 500. So basically this here is just a smaller version of what the VIX index futures contracts were showing you on the previous chart. And again here, like I was saying, pretty much every time there was a very large sell-off, you almost always saw a huge spike in implied volatility or a very large spike in fear and uncertainty. And hopefully that concept is intuitive, right? Because most people in the market are long the market, they're bullish on equities in general. So when stocks go down, especially very quickly and in a very large magnitude, people get very, very scared. And so that's why, of course, when these sell-offs do occur, implied volatility spikes and goes crazy, and so do option prices. But then, of course, conversely, when stocks do finally recover, implied volatility goes way back down. But once again, after this brief recovery here stopped and the market resumed back down lower, implied volatility exploded once again. And the same exact pattern repeats itself time and time again. And so now fast forwarding to recent times, the market has been on a massive tear to the upside, and it's been doing this for almost 2 months at this point. So of course, as you might expect, all during this time, implied volatility has been steadily going lower and lower and lower. And now we're basically at the exact same level as where we were back over during this time in mid to late April, which was also when the last major bear market rally here finally topped out. Now, does this mean or guarantee that this current bear market rally is going to end by tomorrow or next week? No, it does not. This rally here could continue for quite some time. But what this does mean for option sellers, though, is that in these kinds of situations, you should be scaling back your risk exposure, which can be achieved in two possible ways. The first way, which is the way I prefer to do it, is simply having fewer trades on, and therefore having a lot more spare capital just sitting and waiting on the sidelines. And then the second way you can scale back your risk is for any new trades you want to make, just have the risk on those trades be smaller than usual. So for example, if you, let's say, like to sell $10 wide put credit spreads on certain stocks, maybe instead of $10 wide, you go down to $5 wide. But regardless of how you want to go about scaling back your risk, and you can do it in both ways if you want, it's still a good idea to do so in these kinds of situations where the market is just sky high and implied volatility is super, super low, right? Because ultimately here, this massive uptrend is going to end at some point, and chances are the more extreme things get to the upside, then the more extreme things will get to the downside when this uptrend finally corrects itself. And like I explained, when that does finally happen, chances are you will see a massive explosion of implied volatility. So ultimately, if you don't scale back your risk when implied volatility is super low, and then when you finally do get that correction and that huge pop in implied volatility, your current positions are going to be underwater by a huge amount. And then also, you're not going to have any more spare capital on the sidelines to take advantage of the much better opportunity to sell options, right? Because the main goal of an option seller is to find situations where you can sell options with the highest possible premiums. And those situations typically come around when implied volatility in general across the market is very high. But like I said, if you are already way too overexposed with your risk before one of these good opportunities finally comes around with a nice sell-off, then it's going to be tough luck for you because, again, you will not be able to take advantage of that good opportunity because you don't have much capital left over, and then your current positions are going to be losing a lot of money. So it's basically a lose-lose scenario for you. And so now lastly in this video, let's come back to the VIX futures index real quick. And now we'll get a bit more specific on at what values for the VIX you should scale in and scale out of your risk. And so historically speaking, the VIX index is usually around the mid to high teens, which as of right now, we're getting pretty close to at a value of just about 21%. And especially for this bear market, which usually has much higher implied volatility than a regular bull market, then a VIX value of 21% is very, very low. And like I said, this is the same value that we were at a while ago, right when the last bear market rally finally topped out. Right, so basically for me, when the VIX gets down to a low value of, again, the high teens or the low 20s, I definitely have a lot of spare capital waiting on the sidelines. Right, so for example, I think right now in just my option positions, not including my stock hedge trades as well, just my option trades, these are only taking up maybe a quarter of my total capital right now, which for me is definitely on the lower end. And again, that's because I'm just sitting and waiting to see an eventual pop in implied volatility that I can then take advantage of. Now also, when those large sell-offs finally do occur, in most situations, you will see the VIX index get up to a value of around the low to mid 30s, sometimes as high as the low 40s, but again, usually low to mid 30s. And so basically, the higher the VIX goes, the more risk I will put on in my account, right? Because I know that implied volatility is very cyclical in nature, so that pretty much every time there's a huge spike in implied volatility and a huge spike in option prices, it always comes back down pretty quickly after that point, right? So the goal then is to sell options around these points, and then when implied volatility finally contracts, you're going to make a lot of money as an option seller, right? Because the prices of all the options you sold during this time are going to come way, way down. And just to get a bit more specific here, when the VIX does get to a value of, let's say, the low to mid 30s, then at those points, I typically allocate maybe half of my account for my option trades, and then use the other half of my capital to defend those trades with stock if need be. right? So basically, in the most opportunistic situations, I will use almost 100% of my capital. Now, again, that's because my approach here is a bit unique because I do use stock to defend my trades if need be. That does require a lot of buying power. So bottom line, just for your option trades, I would not recommend using more than perhaps 50% of your capital. Now, of course, also that's definitely not a hard limit either. So for example, if you do have a smaller account, then you definitely can go beyond using 50% of your capital. But point being, bottom line here is you do always want to have some decent amount of spare capital at all times, right? Because doing so allows you to withstand some really bad losing streaks, which definitely will happen from time to time. It also allows you to withstand some IV expansion for your existing trades when those sell-offs do occur, because those trades will suffer as a result. And then finally, of course, most importantly, when you do have spare capital, you can deploy more trades to take advantage of very good opportunities. And so with that being said here, that's going to do it for this video. I hope you enjoyed it. But of course, one last thing, as I mentioned, I've got a very cool opportunity for you guys where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.